Welcome back, everybody. We can see that the S&P did reject on Friday. We're going to spend a lot of time talking about the S&P, a lot of time talking about the NASDAQ, the Russell, the divergences we're starting to see, but we're going to start with the basics on Bitcoin, what's going on in the pharma industry. There's a lot of turns there. And something, we're going to refer to it as the canary in the coal mine, something that happened on Friday that I just think we all need to be aware of because it's been looming for some time. We have been talking about it. But if you just take a look at the S&P and how we rejected, people are going to wonder, was this because of Japan and what they're doing with their current buyback of bonds and what's happening overseas? We're going to have to talk about that as well, because that could be another issue that we're just not paying attention to. So there are a myriad of issues that we need to address, not to mention what's happening with, quote, the halvening. So if we just look at this, what do we have? We have a rejection, but I think there's a little bit more here. So what we like to do is just drill into this on the hourly. Now, we can spend time talking about the economic data, the jobs data. We could spend time talking about the ADP data. At the end of the day, it really doesn't matter this week. And why? Because we're not on that leg of the stool. And we're going to bring the stool out for a moment here so people get it, especially those that are newer. But look at where we are on this hourly. Now, you come across and you don't have anything up here, right? You just have blue skies. So surely there really shouldn't be an issue up here. But we are having that issue, and we're seeing it over and over again. Now, it might be slight, but it's there. So I'll address it. We're hitting up here, and then we're flipping, the retest. Now, I don't know why 52.17 is the number. I'm not really sure. Some would argue that it's actually going to be above that. It's going to be these wicks. Let's just say it's in this range. Let's give it a range. And then we can just see the wicks over here over and over again. So we're going to come back to March. We're going to show you the level of rejection, the absolute failure to even get near it, where we're lifting, and then how we rejected and unable to get back over it, because I think that's pertinent. So to dive into the details, you drop the time frame. I know the date's European. I'm working on changing it. Deal with me, right? Just deal with me. I can only do so much. So if we focus here, right, the bonk, 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 oh, everything's fine, yay. And then the test, here we go. And now we're going to rip, right? Because bad news is what? Good news, okay? And if you just take a look, again, for those that already know how to do this, and for those that don't, you're going to learn something new today. All you ever want to do when you have economic data like non-farm payrolls is you just very simply click on the first 5 minutes or 1 minute bar, depending on your time frame of trading, and you just want to mark that off. Why are you marking that off? Let's just drop that to a moment again, and we will focus on this. And you can just see it right there. That's really 2 minutes, but let's go to here for a second. You can see the range. You see if you just dropped it there to the 1 minute, you can see how you're fighting right in there, but this will take you to the high on the 5 minutes. So let's just leave that because that coincides perfectly with this. And most people are not trading off a 1 minute time frame. So, all right, so there's our range. And we could say, now, did we define that range during the day? I would say yes. I would say that was very definitive. And once that range broke, what happened? Well, once that range broke, you can see how we started to roll. Okay, so that broke at 11 o'clock. Now, before I go further, I just want to show you this because this is really what I'm referring to as the issue. So here we are on Bitcoin. And why am I showing this? Because this was the real issue, the real underlying issue. See where Bitcoin at 10:30 just falls out of bed? That's what triggered everything. We could say it's this piece of data or that piece of data. This scared, for lack of a better technical term, the bejesus out of everybody. And once that happened, you can see that mark right there. Once that happened, no one believed anything anymore. It became like the emperor had new clothes, and then you just basically couldn't get out of there, right? You just were in that bubble all day long where people were fighting. Bitcoin good, Bitcoin bad. It's Pokemon cards, it's gold rush, whatever side of the aisle you're on. What we do want to note with this is that out of nowhere, within 5 minutes, your store of value dropped 4%. Okay, that's a problem for people. That makes people uncomfortable. That doesn't make people feel warm and fuzzy. To kind of hammer this point home before we go any further, here's a 1 minute chart. And I appreciate the fact that you watch these without me editing them because I can get to way more data that way. Okay, so was it really 5 minutes, or was it more like 10 seconds and then 1 minute? Well, that's exactly what it was. It was like a minute, minute and a half, and then you're down 4% on your store of value. Okay, so this becomes an issue for people, and it does what? Scares the bejesus out of people. As this starts to happen, it'll start to spread. Right? That scares people. Fear spreads, especially when you're that bullish and people are concerned, right? So here we go again, but let's just follow through on a couple quick lessons that we just went over, and we're just going to mark off but we know that on a 1 minute, you're here 1, 2, 3, 4, 5. So marking the top of that and marking here is like marking the 5 minute, right? You get that because you just basically went through those levels and you just found it. Here, let me show you what I mean by that. See how it's there? Okay. So you already know that the 5 minute, the high of that was that 2 minute bar. So, but isn't that interesting how it respects there? And look where this broke, 11 o'clock. And people will say, oh no, it's something else. Okay. There is the issue of Japan out there, and there are those issues. But when did we really start to break, right? This broke 5 minutes after what? After NVIDIA broke. Okay. After what broke? After everything started to roll, after Dell started to roll. Then what happened? Then you started seeing Meta roll. Then they all started to collapse. Why? Okay, fear. It's really that simple. All right, fear created supply, and when you're this high up, that's what's going to happen. All right, so now let's go back to the Bitcoin for a second, and then watch how this all ties together. All right, so there's your range. And then what we actually did, and we were very fortunate enough in the community, was to actually short these names when this happened. We saw this, we started to see the bounce, and it just provided a really good opportunity to get some shorts on. And the puts for people that wanted to do puts were so cheap. And you have to love this kind of stuff because really all you have to do, I'll give you a real quick tutorial. All you have to do with this, right? I mean, there's your 50% line. We all know that, right? We've all seen this game before where you take the movement and you put 50% on it, even though it's not a fib. And that tells you what? Tells you who's in charge now. And right now, when you have a definitive bar and you put a 50% line on it, very quickly you can tell who's in charge. Is it the buyers? Is it the sellers, right? And you can see that pretty clearly, can't you? Even as I'm recording this at Saturday at 8 o'clock in the morning? And you see this right now, who's in charge, okay? So from this event, sellers are still in charge no matter how you feel about this. All right, so now that we know that, we know where we're at, the other thing that we can always do is you just turn this, because I created this off of fibs. So then you just pop in the fib levels and you just want to see how you're acting in that area, and we'll put the demarcation lines in. And then you can see real clear what's going on there, right? It's just super technical trading that's going on. That's all that's really happening with it. You can see how you're respecting all the levels from that breakdown. But at the end of the day, it's the same superheated. You're not going anywhere. So we'll clean all that off. But that was our trigger. Now, if we take a look at our trigger and we go NQ and we drop back into it, that's the thing that set us off. So when we're looking back at these levels and then we realize that, okay, well, it really wasn't non-farm payrolls that did it. It was the fact that Bitcoin did it. Now, people say, well, what's it matter? A sell's a sell. It matters because, please listen to this. If the defining reason why something triggered does not follow through, it's really not over until that defining thing actually triggers. And what does that mean? It means that if we sold down because non-farm payrolls were higher than expected, right? So let's just say that we did one of these non-farm payrolls, they're never going to cut rates, all that nonsense, right? And then we started doing this kind of stuff. Well, then we'd be in a position where we go, okay, well, we went through non-farm payrolls and non-farm payrolls aren't that bad. And then maybe we would see something like this, right? And then maybe you start seeing this. And then over time, you might get this again. All right. But we're not getting that. What are we getting? We're getting that this event was triggered, in my opinion, and this is an opinion, but it followed through very, very clearly on what we did. In my opinion, this was triggered by Bitcoin and people going, what the heck do I own? And I don't think that got any clearer to people than, when you start seeing a Coinbase out of nowhere, and we actually shorted this and did very well with it. But once this started to break, I just shorted it. I mean, this was a no-brainer short. You drop $10 in a minute, right? Actually, more than $10 in a minute. And then you can't get back up. So this was, I've fallen and I can't get back up. Anybody remember those clapper videos or those commercials? Anyway, if you're taking a look at how this is playing out, you can see really, really clearly what transpired there. And you never got out of your own way. It's like looking at what? Bitcoin. All right. So how in the world are you going to look at these? How are you going to look at MicroStrategies and what's going on there and say that this makes sense? But NVIDIA is the one that should be down because that's the one that's overpriced, right? When did NVIDIA start to crack? 1031. I wonder what else happened around there, okay? Bitcoin, same exact thing. Now, we can look at this, but we should have kind of had a clue that this was going to happen anyway, and we'll get to that in a moment. But more importantly, when we take a look at, let's take a look at this on the weekly for a moment so you can see this. All right, so now we know what I think, and listen to those words, triggered us. But this has been on the table for some time, and we've been talking about the fact that this could happen. We've been looking at a lot of the indicators that are telling us that something like this could happen. Right? We've been staring at RSI, for example. We can pull that up really quickly here and look at the RSI. And let me show you this on the daily so that you can see. And we've been saying that, this is a negative divergence and that eventually we're going to start getting weaker. Now, this is one day. It is not day one, but there's some things out there that you would look at, and this could be, a telltale sign. For example, click on here, and we see that we already saw the negative divergence, and you know that the S&P already followed that, so I'm not going to waste our time on that. What we are going to do is we are going to click off these very quickly, and I want you to watch this, and because this is where we're at. And we're going to get rid of this. That's from the newsletter. If you don't get the newsletter, there is a free version, link in description. All right, so here is your trend line, and that is your trend line from 2000. This is where we hit last time, defining the trend line pretty clearly, or 2020 rather. And then you can see from there, right? We all know what happened in 2020, right? All right. So this is where we're at, and we're at the top of that chart. We can zoom in here and go, well, did we flip? Did we not flip? We did. Did you confirm? A confirmation move is a higher high and a higher high close. You don't have one of those, right? You have this nonsense that we're dealing with now. So all we can do is play the hand that we're dealt. That's all we can do. And this is what we're dealt. So now we have to go and look at it and say, all right, well, and this is where it gets interesting. All right, so this is where we're at, and things are actually fairly good out there. But we did see some cracks. We'll get into the other cracks in a moment. But for those that are aware, there are a bunch of other indicators that I look at. But I want to show you one that ties all together. But if we just take a look at the simplest of indicators, let me find this one really quickly, because this is the one that I tend to go to a lot. I go to the S&P, and then I always want to look at really this. And what am I looking at here for stocks above the 200-day moving average? Because there's two that institutions look at. Institutions will look at S&P stocks above the 200, and they will look at stocks above the 50. They're the two, they're their go-tos, right, on where they're in or out of the market, meaning where are we in the pecking order. And you can see very, very clearly, once again, that when you get to this level, if you were to mark off these and go and look at them on a chart, that these are levels where in the past we have seen some level of weakness. Just as you've seen areas here, look at that, it's a miracle, where you want to buy. In other words, when names are this cheap, usually that 15, 20, 25 area, I mean, that's like you're basically at a trough, right? The amount of stocks that are below there. And you usually want to trade around in some areas and there's usually opportunity that way. But when you start to see this, you want to start paying attention to it. Now, the important thing about this is not just that we're going to focus on one indicator, but I want to show you a way that you can focus on all the indicators, or rather the majority of the indicators. Now, this is an indicator I like a lot and I use quite frequently, and you'll see why I use it. And it's not that common that it will actually go off, and I don't really use it the way that they intend to use it. So this determines risk on or risk off. And what they're always looking at is, okay, show me where the flips are. And then they're saying that risk off is down here. We're going to quantify what risk off actually means. But they're always doing this dividing line. So they're saying 50 is your demarcation. This is when risk is off. And they're saying anything above 50, this is when risk is on. What I'm always looking for with these is, one, how are they calculated? Two, if they're calculated, can extreme readings tell us something? And the answer is yes, they can. I think it's pretty obvious. But what we have to do is understand what risk on and risk off actually mean according to this graph. And this is Sentiment Trader. They do a really good job, but I just want to give them credit. But again, that is their demarcation line, and they are using that 50 very clearly. And risk off, risk on. All right, so we get it. Now, obviously, you can't go below zero. You can't have less than zero risk, right? It doesn't really work that way, and you can't have more than 100. So when you get to these extreme readings, you're going to have to realize that something is going to have to give. But before we even get into that, let's take a look. Not only, we want to cut out this 5-year period in here, and we know why we're going to cut this out, right? Because this is just when the Fed injected all that money in there, so everything there is skewed, because really we were buying stocks and bonds along with the Fed, so it makes it a little harder. But what we're going to do is we're just going to drill into exactly what it is that we're looking at. Construction. This indicator looks like all the indicators listed on, risk off overview. Okay, so you have an overview page of all the risk on, risk off, calculates the percentage of indicators that are considered to be risk on reading 50, good risk environment, under, risk off. See how they're calculating it? Now let's take a look at what they are looking at. So what they do is they take these, I think there's about 12 of them I want to say that they're using. Could be 11, could be more than that actually. I think it's closer to 17, but let's go through it. So you're going to use New York Stock Exchange up volume, excess pessimism, dumb money, fear and greed, risk appetite, stock bond, conference board, stocks, analyst price changes. And what you'll see is you'll see extreme readings on some of these and not on others. But if others are elevated, what I like about this is it still gives them a say. Even if it's not an extreme reading, it still has some kind of say in the risk on, risk off portfolio. And that puts us in a good position. Why? Because now we're not looking at just one indicator. We're not just looking at the bull ratio and saying, oh, the bull ratio is here, therefore X. Or how I mentioned the other day that S&P breadth is up here and people think that that's good, but it's actually an extreme reading. So this extreme reading is actually going to push us higher, but it's not going to overweight the others. And it looks by the look of this that you have 8, I think it's 21 actually, the more I'm looking at it. And summation's not going to be more weighted than something like the bull ratio. So by taking all these together, looking at their demarcation lines and then giving them a weighting, it puts us S&P stocks in a bear market, which is hardly any, which is probably not very realistic, right? But instead of saying this is the reason, risk on, risk off, I think this makes a ton of sense to look at the world this way, quite frankly. And there it is. So when you go through it all and you look at, you had 16 on the other page, 17, 18, 19, 20, 21. So now what happens when we look at these and we kind of get a sense of them? Is there something glaring here? Not really. I don't see anything really extreme on any of these pages. Maybe the percentage of stocks that were above the 200-day or the 200-day moving average on a percentage basis, but nothing glaring. But together, it gave us an extreme reading. And you can see why that's so important, because now that we know how this is calculated and we know it's all those data points, when we're looking at this, it's telling us a different story. So what I like to do is look at past performance as why that is no indication of future performance. It certainly gives us an indication. And one thing that we can see is that when we get to this 90 line or did in the past, well, we had a problem. And that was right here. Now, the problem doesn't really exist until what? Until you start rolling again. But once you got over that 90 and you cracked, and we could see that very obviously, that was pretty much the high. And this is right around the same time that Japan came and intervened. If we take a look here, and we'll also talk about something else that marked a short-term top in the market, specifically in tech. We'll talk about that as well. And you can see where we're at right now. So we are at an extreme reading. So is that a reason why we need to get out of this? And again, they're using 50 and saying it's bullish. You can only be so bullish. There's only so many people that are going to buy stocks, right? My point that I want to get with that is that when you're over 90, you were over 90 for a month. You're over 90. You could say that you hit here a couple times, but really you're here for about a week or two. So it doesn't mean that automatically you're just going to roll because, oh, we hit it and that's it. It's one data point. We want to pay attention to it. What I like about it is it takes all the other data points into account, all of them. So this is something that we should probably look at a little more often, and we will now that you know exactly how it's calculated, because I think that's really important. If you know how something is actually calculated, you can find different ways to use it, and you can actually use them differently than the way that people are actually wanting you to use them, right? Instead of them telling you how to use it, you can just use it your way. Again, sentiment trader down here, and you can see that pretty clearly, right? All right, so then that puts us in another position where we want to go and we want to take out the block of time that we have. And what do I mean by take out the block of time that we have? We want to take out the time and see how this played out, that we're not dealing with COVID, because COVID was completely skewed because of all the money that came in the market. So, all right, so we get to that 100 level up here, and then we just want to say, okay, so did that mark some kind of top? Kind of did. Got to that 90, but never over it, right? All right, so we could still argue that maybe we should pay attention to it because maybe there's something to that. You got a little hiccups. Here, the bond market intervened, but nonetheless, you could see that pretty clear there as well. But, bond market intervention, that really is what set you off there. But this one's pretty obvious, isn't it? Okay. And then this one's pretty obvious. And this had nothing to do, obviously, with COVID, right? And then here you are, and you can actually see that top tick before COVID. Who knows? Maybe it linked. I won't put my tinfoil hat on today. But you could see that. So now we know that if we take out that specific period of time, and then I go back even further. And I think that that's really important. Go back through history and just look and say, hey, is there something to this? And I think there is. I think there is something to it. If we go back to that 90 level, and you're going to just mark that off right here so you can see it to 100, and then go, okay, well, here we are, and then we're over. Well, it didn't break. No, you're coming out. But when did it start? When we started to roll. Did it tell you exactly that it was just going to peak? Nope, just peaked right here. And you can see those levels pretty clearly, right? And then what did you do? Okay, so you can see that divergence, right? Divergences are real, whether we want to believe them or not. You see right here, and then you can see over here as well. And then you can see here, and then you can see this as well. And all I'm getting at is, does it work 100% of the time? No, nothing does. Nothing works 100% of the time. But when you start to look at this over and over again over this 3-year period that between 2010, 2013, this is telling you that these are times where you need to be aware of what's going on. And I thought this was worth pointing out. Now, does that mean that we're going to roll? No, I think there are other signs that are telling you that tech has some issues, and we're going to talk about that right now. So that you understand that, to me, I'm always looking for data. That's always, even with what we're about to go through, I'm always looking for data. Now, what that means is, if I can get something like an aggregate, like risk on, risk off, that tells me a lot about where everybody is, because people will say, oh, I don't use that. I don't use the McClellan. I use this, or I use that. Sentiment Trader does a really good job of that. It is a paid product. I have reached out to them before. They're fine with me using it. If you find that useful, I will show that the same way I do Smart Money, Dumb Money. And I do find it helpful. But I want to really hammer this home. I know the date's wrong. You don't have to comment, but people will comment now anyway. So here's Bitcoin, and this is what I want you to get. This is the open of the market. This is where Bitcoin peaked, and this is the market chugging along. So if we are to do the simplest of things, and we're just going to drop this down, we're going to take the RTY out, we're going to take the SOX out, we're going to take out the ES for a second, and you should be able to just very simply get a demarcation line and drop it right there. And then we can see very clearly, what can we see? We can see that Bitcoin marked the high. All right, so let's get rid of that. ES seems to have done what? Mark the high. Okay, there we are with the SOX. What did it do? Say it with me. Mark the high. All right, what didn't mark the high? The Russell. All right, see how the Russell went higher? What does this tell you? This tells you that specifically we should be looking at smaller cap names that are not tied to the indexes. This tells us specifically we should be looking at small cap names that are not tied to the indexes. Why? Because some of them actually went higher. Okay, some of those actually did go higher. And that is where I think that we're heading into this next leg of the market. I'm going to be really clear. I do think that Friday was a shift. And I don't think it's the be-all, end-all, but I do think it's a shift. And it's a shift that's happened in the past. Now, if you are in the community and you've watched the pre-market newsletters, or I'm sorry, if you've read the pre-market newsletters, and if you saw some of this other stuff that we've been going over, then this might not have been the biggest surprise in the world to people. And what do I mean by that? Well, there's a couple times that we've been trading and there's an event that will mark exactly what's going on. And AVGO has been that event for a period of time. We talked about this. People will forget, people will remember, and not everyone can watch every video. So I'm going to walk through it one more time. If you go back here and you look at this day on May 30th, and you just take a look at these very specific dates, right? You go May 30th, and then you go here and you go August 31st, and then you go here and you go December 8th, and then you ran up from here. And we're just going to mark them, okay? And it doesn't always work, but guess what worked the other day? Now, AVGO, just so we're all clear, I want to go through a trade today for sure, but I want you to get this. So what you're seeing here more than anything is a classic reversal. All right, that's just a classic reversal. So, it's definitely over. The internets are dead. No one's ever buying a semiconductor again. Remember this a year ago? Oh, the internets are dead. No one's ever buying this again. 9 months later, it's breaking out, and everyone's saying, I knew I should have held it, right? Remember? Okay. So you have these dates now. If we overlay these dates, and this is a really important concept for people to get. Now, this will look like a blip right now. Like, oh, that's nothing, right? When that happened there, or, oh, you mean that marked the high over here? And so let's just mark that again and look at that, okay? So again, we did go over this in one of the pre-market videos, and we have been talking about this. What I'm starting to realize with educating, or how I feel educating should be done, to make sure that I have that right. Yep, and this one's wrong. I realize I have to go through concepts more than once, more than twice, sometimes 3 times. But I think that that's exhausting. But you forget what you don't know. Anyway, if you look at those levels, people would go, oh, well, that's just a blip. Is it? Is it a blip? Because I'm glad you asked. So let's take a look at this. What looks like a blip now was catastrophic in May, and people forget this. So this is where you're at, and we gap up, and NVIDIA is at 420, okay? And it gaps up. Measure from the peak of there to this low, all right? That is a 10% move, all right? And people forget this. So what I always do is I always look at past performance because it's a sign of future performance. It does not always mean it's going to happen. Quite frankly, I thought AVGO was an excellent quarter, and I thought it was going to go up. I actually held calls into it and lost money on those calls. And we're going to talk about winners and losers here in a second, because there's a huge misnomer the more that I show this data about P&L and how to trade. But you see what I'm getting at here? This was catastrophic. That was it. The high is in. It's over. That was at 400. Today, people are panicking. Why? Because it's at 875. And clearly, that marks the top for all time. All right? It doesn't mark the top for all time. It marks the top for Friday. And that's all you know. You don't know anything more than that. Now, can you look at that and surmise some things? I think I can. I think I can look at that and surmise some things. I think I could look at that and say, well, if you're at an 87 on RSI and we're this far off where we are, then yeah, these things can crater. I think I can surmise that. I think I can look at other data points and go here on a weekly and drop in like the Bollinger Bands, for example, and we'll drop those in right here. I'll show you what I mean by that, and get rid of this and look at this on a weekly and say, yeah, I do think I can surmise that we're at a second and third standard deviation up here. And now I have a doji on the weekly and I should pay attention to that. Same way I could look at SOXL and go, because XOXL is always going to be a precursor because it's juiced up, right? SOXL is at a third standard deviation on the weekly. Is that where you want to buy it or is that where you want to sell it? Well, when you hit that, and we know this from our past experience, that marks what? That marks a very clear demarcation of you have a 99.7% chance in not going higher. And right now, these can expand, and we know that. We've seen that play out, right? We've seen them expand. Look at MicroStrategies and how it's expanding, right? But now you're completely out of the realm of, in my opinion, reality. And as someone that's been playing it for a period of time, the options, when I'm start buying weekly options and the in the monies are $150, well, there comes a time when you start selling puts and you start selling calls, right? But that's a video for a different class. If you see these ranges, you have to start using some level of logic. See how you popped out over here and then it reversed a week later? I don't know. We'll have to look at this in a couple weeks and see, a week or two and see what it does. But to not use this and to not look at this, to me, would be a mistake. And it's the same thing when you start looking at the Qs on a weekly and going, well, you are on a weekly basis. You're still up here, but you're at this higher level. It's still something you want to pay attention to. But you want to use all the tools that you have. So what I like to do, I'm going to drop this to a bear chart. So what I like to do here, and I also look for periods of exhaustion. Now, this is something that a lot of people don't have access to, but if I look at the Qs here and I use DeMark and I just take a look at where we're at, you're getting a little tired up here, right? So that's something that I want to pay attention to. Watch this with the SPY on a weekly, and we'll get rid of this as well. And I'm starting to get some signs of exhaustion with DeMark. And again, this is not something, you have a sell signal here on the SPY on DeMark. It's not something that's a be-all, end-all. You had one here. A week later, you took out the highs. But they are, and this is how I use them, and I'm not going to spend an inordinate amount of time on it, but they are signs of things that you need to pay attention to. But it's really important for me to show you how to use all of this in application. So there's a couple misconceptions I really want to go over here. And we're gonna do this differently. But one of the things people keep pointing out is, wow, I thought your win rate would be different. Let's start here so that for those that are watching this for the first time. So let me click off of this for a minute, get rid of that up there, because I was looking for a really good explanation here on how to explain this. Now, I will say this as well. People have asked for this, or I've offered it, and then people have asked for it. You want to see time and sales on any of these trades so that you can walk through it? I have zero problem with that. I'm actually going to show that today on some of these so that you can actually see that, and I can just present all the data. This is what I am up. I want to be very clear. This is one account, and this account is specifically for the Alpha Chasers community, where I do the ideas that are in there, and I day trade them and short-term swing ideas. That's what's in there. The account started with, I think, 180 or 200, close to, I would say close to a quarter, but it was under a quarter, somewhere around there, but it's up over 100%. And why am I pointing that out? That's the win ratio on the account. And there's this misnomer that your win ratio is going to be 70 or 80. It's not going to happen. It's going to happen for a day or two, but it's not going to happen. If I can stay here at that win rate and my profit factor can stay here, you are golden, period. It's not even a question, all right? And then the win is 2-1 right now, but that's on the year. Now you're going to have ebbs and you're going to have flows. But here's what I really wanted to point out. So you see this Zella score. This is TradeZella. It's a great product. I have no affiliation with them. I have nothing to do with them whatsoever when I say this. I've been coaching guys doing this for going on 17 years, way before, almost 18 years now, even before I started the community, which has only been open about 2.5 years. I used to have people do their own spreadsheets, input their own data. I had people switch to this thing. I think they do an excellent job. that which gets measured get results. Even if you don't want to use TradeZilla, I don't really care which one you use. If you're not journaling on some level, you're not taking this as seriously as a person that wants to be a professional should. Going to leave it at that. So here we are, Jan, and this is where we're at. And I'm not always going to show this, but there seems to be a good time to do this. So you see this win percentage, average win loss, and profit factor. And then they give me a score. That's out of 100. So if you think about it, that means that 75% for the year, 25% of people are doing better on an average of these things than me. All right. Now, why is that important? It's important for me for this. So if you just take a look at this on the win ratio for a second, my win percentage on here, they're saying overall, the Zella score is 89%. And they're saying the win ratio is a little lower, and I have to go back and take a look at how they're doing that calculation. But it's a little off from what this is saying. But okay, 89%. That means only 11% of the people out there would have a better win ratio than that. I want you to think about that for a second the next time someone tells you that they're doing 70, 80%. The profit factor is at 2.35, meaning that's what you're making, 2.35, 78%. Okay, so when you start thinking about that, that means only 22% of people have a better profit factor, and that could be higher, right? I'm cutting things super fast right now, okay? And then the win-loss ratio, okay? Average win-loss, 66%, okay? So what does that tell me? Well, that these people have wider ranges. And why is that important? Well, I'm probably trading a little faster than they're trading, right? So my win losses are going to be a little lower. I'm fine with that. I really don't care. But it shows you how you're getting to here and what these numbers are. All right, let's get to it. So really what I want to show, this is January, so you can see what's happening there, right? Yes, you have red days. Shocker, I know, right? February, you have some red days. This actually was me building a VKTX position because I thought it was going to rip. How'd that work out for me? Not very well, because you had something change. This is March, and I know, can you believe it? I actually had a down day, but yes, it happens. Again, I can provide all the data for this, but why am I showing this? Let's go to March for a second, and I'll show you why I'm showing you this. And I want to show you this trade, because this really got to me the other day when people were saying this. So this is March, and for March, you can see my win ratio is 53.46%. You're at 3 here. And then for TradeZilla, right there for the month, I'm at 96.4, which means average together, 3.5% of people are doing better than me. Okay. Profit factor, 3.41. Just to put this in perspective, I want to really get this point home. Hopefully you can see this. If not, zoom in on it. But this profit factor that's sitting right there, what is that telling you? That's telling you very, very clearly that if you're at 3-to-1, you're in way above the top 1% of people that are out there, right? And then you look at the win ratio, 87%, right? And it's telling you it's a little lower than it is, and they're showing you the average win-loss. So if your average win-loss is at 2.9, let's call it 3, you're in the top 1%. So if you can get to 3-to-1, you're in the top 1%, period, okay? And if you're here and your profit factor is at that level, no one's even touching you, all right? So when I look at this on the body of work and what I'm trading, this is, when you look at this, you have to understand you're looking at a level that you're going to be this kind of trading, and this is really important to get for what I'm about to show you, is pretty much top 1% of what's out there for this particular period and snapshot in time. And at that top 1% level, okay, I'm at 53.64%. Hopefully you get that concept. All right, so then we're going to take a look at the P&L. Now, you can see the VKTX, and this is what I want to go through. They don't aggregate the trades. They take the trades and they separate them out. Now, you can aggregate them yourself, and you'll see that with the win-loss is. But this is really important for people to get. All right. And so what you're going to see is you're going to see something where we're going to watch a video in a moment where you're going to see the live trade and how fast this stuff happens, how fast I move. But this is the kind of stuff that I love to show. So I'm going to show you a loss so that you understand this. Now this says 30 minutes. And so we're going to drop this to a minute. And I want you to get this. So what I saw here on this chart was I saw a spot right here where I thought for sure we were going to hold. I had all these indicators blinking. Everything said it was going to hold, everything. So I go out there and I buy, looks like I bought 100 shares here. And then by the time I got out of it with barely alive, what happened? Right? Wham, $7, okay? My stop on this trade, let's walk through this trade. All right, so you understand, I thought for sure this is my reversal. I was probably looking at RSI. I'll have someone tell me, I told you RSI doesn't work. Nothing works all the time. I was probably looking at something, right? So I had a whole myriad of things that truly were telling me that this is the bottom. This is the move, right? you could look, someone's going to say, well, your volume was here, whatever, right? There's a myriad of things that people could pick apart about this trade. I got it. But there I am again with my stubborn head and want to get into NVIDIA. So I find a spot and I buy it. All right, I put my toe in the water, right? So this is what I mean when people in the community will know this, but I also say like progressive exposure. I put my toe in. All right, well, my toe got bitten off, right? And I lost $7. What was I supposed to lose? The low of this bar. Okay, when I put the trade on, I was supposed to lose right here. You'll see it. I was supposed to lose that 917.25. What did I lose? By the time I got out of it, I'm getting out here and I'm getting out at 913. Okay, that's called negative slippage. Negative slippage is bad. But hopefully you get this. You're going to have losses and it does not define you, right? What defines you is what you're going to do about those losses. And all I did with this later in the day, and it won't show this, I don't believe, but we did other trades on it, and those trades did, later in the day, those trades did better. Another important concept why I'm on here. Okay? All I'm doing is constantly pulling money out of the market over and over again. So we do this trade in the community, and there's certain parameters I'm not going to bore everybody with, but we buy here, right, at the end of the day, because we know that we're going to get a gap up in the morning, or we have a high degree of probability of getting a gap in the morning. Let me say it that way. So I'm buying at the end of the day. Please look at what I'm doing here, right? All I'm doing, right, it says this. I don't know why it's showing that. It's weird that it's showing it that way. Like maybe because I had limits in. I had limits in. That's why it's showing it that way. But I bought 200 shares. I didn't go crazy. Right? I didn't buy a couple million shares or a couple $1 million worth of stock, even though overnight with the size of the account, I think it's like 4 something now. I could. It depends on how your margin is calculated. But all I'm doing is buying at 8 and we're selling at 7. Now, I didn't want to sell at 7 because I wanted to see if we were going to rip because of what was going on in Asia at 4. Didn't happen. I blew it out. I locked it in. And by doing that, I saved myself this and then allowed myself for another setup. Let's take a look at that setup and then we're going to get to it. Now, let's look at the morning setup and then I want you to watch this play out live and then I want you to watch how fast we switch. And again, this is day trading and short-term swing trading. So what I'm doing here, right as I'm probably actually doing the pre-market live at the time I'm buying this, actually I am. So as soon as the news hits and we start look like we're going to break out, I start an initial position in this because I know I wanted to own a lot of it today. I think I was in like 400 shares at one point. And then what I'm starting to do is I'm watching and then boom, it starts to break out. I start to scale into it. I start trading out of it, pulling money out. I see something else I like. I add to it. It pops back up. I scale out of it. You see that? How that one actually didn't work out from that spot. Didn't really work out. You're going to watch this live in a second. And then I add to it again because now I see what I want, right? I've got this particular pattern right in here where I love these dragonflies. They're so obvious and they just make life so easy. And then I'm scaling out. I mean, remember, wicks are a price rejection, right? So when you see these things, I mean, it's just price rejection. It's not rocket science. Like, it's really simple to pick up once you see it. All right, and so then you start pushing. What am I doing? I'm not cheering and high-fiving all my bros. I'm actually scaling out into the people that are paying up for something that I bought cheaper, right? That sounds like a good idea, doesn't it? And then we start to see the reversal, and then we get out. Now, that doesn't mean that I think it's done, because later in the day, I find another spot where we put a trade on, and my hope, there I go again, hoping, right? It's pretty much the devil of trading, where I can get in. And what I'm looking for here is when I see this bounce, I see this particular move and pattern, I want to get back in. So we saw another pattern here, and then we were actually able to buy, put the trade on, and have it work out perfectly. And I'll have to pull something out to get up and in and then just put the break even behind it. But I'll save that trade and why we did that for another day. But more importantly, what I wanted to go over and the concepts that you should be getting from this are the following. Number one, nobody has this huge win rate where everything they do works all the time. And if that's the case, maybe you should honor your stops, right? Maybe that might be a good idea. Number two, you can always get back in. You can't always get out, all right? Keep that in mind. Here, watch this play out and watch how fast the market turned and how quickly we were able to pick up on it. Now, I hope you found that helpful. Your comments are how I create content. I want to be really clear about that. So comment below, let me know what you think of that. I think it's extremely helpful to connect all those dots and so you have a framework. I'd like to do a little bit more of that kind of work if it's something you want to see, but I don't know that I'm going to show the P&L as much all the time, but I do think it is helpful to some extent. I do want to go through a couple core concepts here of things you need to be aware of before the week starts. So the BOJ contemplates ending negative interest rates, a shift from the horizon. This hit on March 8th. Why is this important? If you remember, and I'm putting the link in here specifically so you can see the link. If you remember what happened on July 28th, 2023, and you probably have a life, so that you aren't aware of this, but this is actually what caused the market to go down last time, and it's definitely something that has to be on our radar. It is possible that it doesn't have the same effect this time because we're dealing more with a fundamentally driven market, right? Remember the stool. You have the legs of the macro, the fundamental, and the technical. Again, trying to keep these to less than an hour. So I want you to just remember this concept. And here's the link if you want to take a look at the link. But what are the ramifications of now? This is something that we're going to have to cover in greater detail later. But I want to just get the core concept down. This is the dollar versus the Japanese yen. And remember, the Japanese yen in the DXY makes up a very large percentage of it. I believe it's 14 or 17%, something like that. So you always want to kind of pay attention to what's happening here. Now, if we take a look at how that's playing out, besides the fact they own the majority of U.S. debt at this point. But if you take a look at how this is going, when we get to this level, we keep seeing these rejection points, and we're starting to see this somewhat reject, aren't we? Now, what happened in the past? Well, this was July 7th, 8th, starts to pull back, rallies up, right? And we start to have these issues. You'll remember this. And then we start to collapse, and then we start grinding higher. The dollar starts going higher. Why does the dollar go higher? Because of things that Japan is doing to intervene. If we start to see something like that, and let's just say that the dollar starts getting too strong, you could see industrials drop. So we want to watch this pretty closely and see how this is going out. Now, for the past couple days, since about March 5th, we're starting to see it drop. What would be interesting for us is to see, is this having any ramifications? So the one sector that is the most affected by this is going to be the XLI. And what you're seeing is the XLI has been on a tear. And you're not really seeing any major ramifications to the XLI on this at all. But we do want to look for signs on that. We do want to watch how that is playing out. We want to be really careful on that. And we can see our levels right here very clearly on how you have the left shoulder, the head, the right shoulder. And what we'll do here is we're just going to drop where I think the neckline should really be drawn. Bonk, head, bonk, bonk. And then now here, so you have a rejection. Usually these rejections are pretty vicious, aren't they? You know, if you have a rejection of a head and shoulder at any particular kind of pattern, it becomes a problem. And now we're below the 200 again, which means this could roll. Could this be a catalyst that helps us with the S&P versus what's been helping the NASDAQ? It could. It could also be one of those things that starts helping oil, right? It could be something that starts helping XOP, XLE. It could. And we're starting to see signs of that. Isn't that interesting? You start taking a look at XOM and start looking how XOM is setting out to break out. So this can have a positive effect on some of these global companies. Specifically, it does affect oil and it does affect the underlying companies. So this might be something to look at. And then based upon affecting those companies, you might want to look at how it's going to affect KC if oil prices go higher, and MUSA, see how it's all connected, and start seeing if they're going to have a problem, if what? If crude goes higher and they're locked in at other prices. So we're probably going to want to watch crude too. One concept we just need to be aware of as we go into next week. So I hope that is very helpful. Another concept that I think that we need to be aware of is we don't always know what's going to happen. So what do I mean by that? So VKTX was a company everybody was going out there and saying was going to get bought. Now, this is really a very important concept for people to get. And I think a lot of people struggle with this. You had really good data that blew the cover off the ball. And I am by no means an expert in this space, but I've watched this stuff play out for 2 decades. And it never ceases to amaze me. You learn something new all the time. So we watched NVO come out with a competing drug. Now that competing drug with NVO puts us in a position where we're seeing a breakout, all-time highs on NVO, right? All right. So what do we know about this? We know that, is it possible that everybody was wrong and that VKTX's data, okay, is not as great as people think it is, and that all the oral data is going to be better than expected? Well, that's what people are starting to think, because the people that raised money at 85, that bought 85, they're no longer supporting the stock. And that's becoming very clear. So you always want to be aware of that, and a bird in the hand, right? So once you broke 85, you have an issue. I want you to be aware of that. And it also goes back into here. Like, this was something that we did exceptional at. And CYTK, we actually got in early. We were actually able to take advantage of some of this in the community. If you are on the wait list to get in the community, another batch of invitations will go out this week. So but as you see this start to rise higher, what's happening here? We're getting out because people are saying, well, we're looking at $1.20, $1.30 for the merger. And so these are expectations. This goes back to that concept I talk about all the time of reflexivity. I'm going to cut that out so you guys can watch it. But what does everybody think? versus what is the outcome, right? And that differentiation is where you make your money. Really important concept to get. I am going to clip that out so I can start linking that behind this so you can remember that concept. It was a month ago, but instead of me saying, go watch this video from a month ago, maybe if I clip it out, you'll start to get it. But anyway, so here, everybody knows it's going to get bought out. What's everybody not thinking? The CEO doesn't want to sell. So the CEO does not want to sell. He wants to run the company. He wants to see it to fruition. Well, this is going to take years, billions of dollars. You're going to have to do secondaries, very different than the people bought up here. So the concept that I want you to understand is we don't always know what's going to happen, right? And that's what makes a market. The important thing is for us to look at all the variables that are out there and make the best decision that we possibly can. That is all we can do. That's it.